Hey everyone, and welcome to today's Explainer. We're going to jump right in and conduct a sort of forensic autopsy on one of the most dramatic, whiplash-inducing financial events we've seen in recent memory, the 2025 to 2026 crypto market crash. Look, we all saw the headlines, right? We all felt that extreme, almost dizzying optimism of late 2025 when Bitcoin was just smashing records. And then, well, the floor completely fell out. Today, we aren't just going to rattle off the numbers. We're really going to look at the why. Using the latest data, we're going to systematically unpack this massive crash to understand exactly what broke, why it broke, and what it actually means for the future of digital assets. $2 trillion. Just let that sink in for a second. That is the staggering amount of total market value that was completely erased in less than 6 months. To put that into perspective, that is like wiping out the entire GDP of a major developed nation. Just gone, in the blink of an eye. So if you've been sitting there watching your portfolio bleed and wondering how things turned so sour so quickly, listen, you are definitely not alone, because this wasn't just a simple everyday dip. This was a massive, system-wide structural reset.
To make sense of this whole mess, here's our roadmap for this explainer. First, we'll map out the crime scene. Then we'll investigate our 3 main suspects: macro shocks, market mechanics, and investor psychology. And finally, we'll deliver the verdict and put this whole crash into some much-needed historical context. Let's get into it.
All right, part 1, the crime scene, $1 trillion vanishing.
To really grasp where we are right now, we have to look at how far we fell, and honestly how incredibly fast it happened. The sheer scale of the devastation across the board was just staggering. Back in October 2025, Bitcoin hit this dizzying all-time high of $126,272. But by early 2026, it had dropped roughly 48% to around $65,600. And Ethereum was hit even harder, plunging about 60% from nearly $5,000 down to under $1,826. Overall, the entire crypto market cap plummeted from $4.4 trillion to roughly $2.3 trillion by February 2026. This was a market-wide vanishing act. But you know, markets don't just lose $2 trillion in a total vacuum. So let's move on to our first suspect.
Suspect number 1, macro shocks and what I call the global liquidity squeeze.
For this, we actually have to zoom out to the global stage, because the actual triggers for this crypto crash started entirely in traditional finance. On one side of the globe, we had a major sudden shift in U.S. trade policy. The U.S. rolled out a 15% global tariff, plus a massive 100% tariff on imports from China. Objectively speaking, and totally putting politics aside, global markets reacted to this as a huge inflationary risk. It sparked this massive global risk-off tide. Capital just immediately fled from high-risk assets, and yes, crypto was right in the front of the firing line, straight into safer havens. But simultaneously over in Japan, we had another massive shift. See, for years major institutions had been borrowing the Japanese yen for practically zero interest, swapping it for US dollars, and then investing in risky assets like crypto. This is what's known as the yen carry trade. But suddenly, Japanese yields started rising, which meant those institutions actually owed real interest. To service that debt, they had to quickly dump their risky assets. So you've got a US policy shock pushing capital to cash, crashing right into a Japanese policy shift, forcing massive institutional selling. It was literally a perfect storm for a global liquidity squeeze.
Now let's look under the hood. Suspect number 2, market mechanics and the domino effect. Because macro shocks alone don't fully explain the sheer visceral violence of these price drops. A normal market pullback turned into a catastrophic collapse because the crypto market was heavily leveraged. People were borrowing a ton of money to bet the price would just keep going up forever. So when those macro shocks caused step 1, that initial price drop, it immediately triggered step 2, margin calls. Exchanges essentially stepped in and said, hey, your account is underwater, you need to add funds right now or we're selling your assets. And because this is crypto, step 3 is automated forced selling. The trading algorithms just start indiscriminately liquidating positions. This massive sudden wave of selling drives the price down even further, which triggers step 4, hitting the next guy's margin call, forcing even more selling. It becomes this ruthless automated domino effect that is completely disconnected from the actual fundamental value of the assets.
And this brutal domino effect really culminated on a very specific date, October 10th, 2025, the 10/10 flash crash. On that single day alone, a record $19 billion in leveraged positions were liquidated. $19 billion. That is the largest single-day liquidation event in the entire history of crypto.
It completely hollowed out the market's depth, meaning there were practically zero buyers left to catch the falling prices.
And hey, it wasn't just the highly leveraged retail traders getting completely wiped out here. The big institutions, they ran for the exits too. We saw pronounced, sustained capital outflows driven by major investment advisors and brokerages. In fact, the Bitcoin ETFs, which were practically the engine of the entire 2025 bull run, they completely flipped to being net sellers. We're talking about a massive $3.8 billion outflow streak over just 5 weeks. The big money was absolutely leaving the building.
Which brings us to our third suspect: investor psychology and the contagion.
Let's be honest, money is deeply emotional. And the psychological whiplash from the sheer greed of late 2025 to the blind panic of early 2026 was severe. The crypto fear and greed index plummeted all the way down to an 11. That is deep into extreme fear territory. And it was the lowest sustained reading we'd seen since 2022. When fear takes over like that, fundamentals completely go out the window, and investors just start fleeing the falling knife. But why were they so uniquely terrified of crypto during this specific time frame?
Well, we have to break this down because this is where the grand narratives that actually supported the 2025 bull run really started falling apart. First off, cryptos showed a massive correlation with a broader drop in tech stocks. Basically, when the Nasdaq bled, Bitcoin bled right alongside it. Second, we witnessed the sudden bursting of the 2025 AI crypto bubble. Big tech companies started missing their earnings, traditional investors started demanding to see real returns on all this AI spending, and that panic spilled directly over to Ethereum and AI-related crypto projects. But honestly, perhaps the absolute most psychological damage came from the failure of the digital gold narrative. For years, we were told Bitcoin is a safe haven asset, right? A digital hedge against global instability. Yet, while global geopolitical tensions were flaring up, traditional physical gold rocketed up 17% for the year, while crypto absolutely tanked. It traded exactly like a speculative, highly leveraged tech bet, not a safe haven, and that realization really shattered a lot of core investor confidence.
So let's wrap this up with part 5, the verdict, historical context, and recovery. Okay, so we've investigated our suspects, the macro shocks, the automated liquidations, and the total collapse in psychological narratives. Now we really need to zoom back out. Have we seen this movie before? And more importantly, is it over? Look, as incredibly painful as a 48 to 52% drawdown feels right now, historically speaking, it's actually relatively mild for a crypto bear market. If we look at the cycle data, 2014 saw a brutal 85% drop, 2018 an 84% drop, 2022 gave us a 78% drop. The 2026 crash, which is sitting around a 52% max drop so far, actually points to a completely different kind of market. This cycle has been much more of a slow, structural bleed punctuated by those violent liquidations, rather than an absolute bottomless pit. This strongly suggests that the heavy institutional participation we have now, like those major ETFs, even if they were selling, might actually be providing a much higher structural floor than we've ever had in the past.
So, the million-dollar question, where do we go from here? Expert projections are varying wildly right now, which is exactly what you'd expect in a climate of extreme fear. Some traditional financial analysts are definitely warning of a further drop, maybe down to the $38,000 range. However, major firms like Bernstein actually expect Bitcoin to find its ultimate bottom right around the $60,000 range during the first half of 2026. They point out that historical post-peak bear phases generally last anywhere from 9 to 12 months. So if history rhymes, 2026 could ultimately be viewed as a really painful but completely necessary accumulation phase before the next major market expansion.
Which leaves us with the ultimate question to take away from this explainer today. Is this structural reset finally complete? Has the market actually purged all of its dangerous, excessive leverage? Or are there still hidden dominoes waiting to fall if macroeconomic conditions get worse? The core fundamentals of blockchain technology haven't vanished, but the market's tolerance for pure, unadulterated speculation certainly has. You want to keep a very close eye on global liquidity and those institutional ETF flows, because they're going to be your absolute first indicators of whether we've actually found the floor or if we're still falling. Thanks so much for joining me for this explainer, and keep learning.